Snap and Meta Platforms were both on my list of top stocks to buy for 2024. Unfortunately, their performances were significantly different. Meta Platforms has delivered 78% year to date returns as of this recording, while Snap is down 33% as of this recording. But what about 2025? Which one is the better buy for 2025? And could the performance be flipped next year? That's the question I'm going to answer in this video. Looking at these two social media companies, their historical revenue growth, cash flow from operations increases, the return on invested capital, and then finally comparing valuations, looking at the forward price to earnings multiples of these two social media companies, and also comparing my discounted cash flow valuations of these two social media companies, and which one seems more undervalued heading into 2025 and which one could be the better investment for 2025 for investors like myself. So let's take a look.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
So I shared with you in the introduction of the video that these two have been on my list of top stocks to buy all year, and Snap has been one of my worst performing recommendations this year. It's down 33% year to date, while Meta Platforms has been one of my best performing recommendations. It's up almost 78% year to date. I've also had Nvidia as one of my top stocks to buy. That's been actually my best performing recommendation year to date in 2024. When we compare these two on revenue growth, you'll notice that they've both been growing revenue. In fact, Snap, over these years that I have highlighted here, its revenue has actually increased by almost 10x since 2017. A 10x increase in revenue for Snap. But even with that 10x increase, you can see it pales in comparison to Meta Platforms and the sheer magnitude of revenue that Meta Platforms has generated. And even though the rate of increase might be slower for Meta, the number, the billions of dollars that it has increased is much larger than Snap, which has added roughly $5 billion in revenue in the last 6 or 7 years, while Meta Platforms has added roughly $100 billion in growth in the last 6 or 7 years. Looking at the most recent trailing 12-month period, Meta's revenue of 156 billion puts it behind only Alphabet in terms of annualized revenue from advertising. Alphabet is up closer to $300 billion and Meta's in second place. But digital advertising is the part of the industry that's growing the most quickest. It's the area where marketers find most attractive returns from their investments in advertising. And I don't suspect that will ever change going forward. Digital advertising allows for measurement, where if you're advertising on a billboard or in a physical newspaper, if people still read those nowadays, you don't know how many people read it. You don't know how many people saw that advertisement. You don't know how many people took action after seeing that advertisement. Whereas with digital advertising, you know precisely how many people saw it, how many people clicked on it, how many people made a purchase, how much they purchased. And so you can compare your spending with your return and realize if you want to increase or decrease in certain areas. You can target more effectively, you can tailor and enhance. It just offers so much more advantage than traditional forms of advertising. And so this is still a growing area of the advertising pie. It's still not even close to 100%. It's still roughly around 65% of total advertising. 35% is still on legacy methods, which are going to eventually convert over to digital advertising and areas where Snap and Meta will benefit. Now, Snap and Meta have also improved their cash flow from operations, and a similar story, right? Snap has done a great job in increasing its cash flow from operations from a hugely negative number to now positive 347 million. But again, it pales in comparison to Meta, who's increased its cash from operations all the way up to $82.7 billion in the most recent trailing 12-month period. And if you look at cash flow from operations to sales, you can see Meta has generated over 50% in cash flow from operations to sales, whereas Snap with 347 million in CFO compared to revenue of 5 billion is still less than 10% of CFO to sales. Now, it is working on improving that number, but it's still far behind the likes of Meta Platforms. Meta Platforms is a sign of what Snap could become at larger scale. This user generated business model, Meta Platforms and Alphabet have proven to be incredibly lucrative, and Snap at larger scale can benefit from those same factors, those same fundamental factors that make this business an attractive business. There are some businesses and some industries that are inherently attractive for investors because they generate good profits, good cash flow at relatively limited risk with relatively little capital investment required. One of the areas that have been attractive is the user generated content business model, or in other words, the social media business model. This is one that I've been recommending to investors for several years now because of those fundamental factors. Looking at the return on invested capital, again, a similar story with Meta's number being much larger at 32%. But the rate of improvement favors Snap because it's coming from such a negative place that these improvements are moving along much faster for Snap, whereas Meta, it is improving at 32%, up from around 16%. So it's nearly doubled its ROIC. But Snap has improved to negative 16%, all the way up from negative 120%. So now that we've looked at those financial metrics, let's look at the valuations. And when measuring by a forward price to earnings ratio, Snap is slightly more expensive than Meta at a forward PE of 27.5 compared to a forward PE of 24.8 for Meta. But when I look at the discounted cash flow valuations, Snap is more undervalued than Meta Platforms according to this metric. Snap, my intrinsic value calculation for Snap has it at $24.34, more than double the current market price of $11.40, whereas with Meta Platforms, the intrinsic value per share I have is $589 and the current market price is $629. So the market price has surpassed the intrinsic value per share for Meta, partly because of the rapid increase in share price here in 2024. The stock price has increased by so much. Like I shared with you, it's up 78% year to date already, when Snap is down 33%. So the opposite factors on price change has had the opposite impact on the discounted cash flow compared to the current market price. So in conclusion, which one do I think is a better stock to buy for 2025? This is a close call. As I highlighted in the beginning of the video, I like both of these. I have both of these rated as top stocks to buy right now in 2024. But if I had to pick only one for 2025, if I had to pick one that I think will have a better performance in 2025, it will be very close. But I think I would go with Snap over Meta Platforms because of the undervaluation being more magnified in the discounted cash flow valuation model and the improvements in cash flow from operations that are expected from Snap. The rate of improvement is expected to be much faster for Snap than Meta Platforms because of the company's smaller size and more room for upside over these next several years. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.